Hello and welcome once again to another MindMap session. I hope your exam prep is going well, and I also hope that I'm easing your journey in some small way through these videos. Today I'd like to talk about the weighted average cost of capital. Now there are two broad contexts within which this material is likely to show up on the exam. The first has to do with the actual calculation and interpretation of the weighted average cost of capital for a given company. And this is material that I'll deal with in a later video as I expand this mind map. The focus of this video is the capital budgeting context. Now within the capital budgeting context, there are two areas that I want to talk about. The first is explaining how the weighted average cost of capital and the investment opportunity schedule are together used to determine an optimal capital budget. And the second is explaining the role of the weighted average cost of capital in determining the net present value of a given project. The weighted average cost of capital is also known as the marginal cost of capital, or MCC, because it's the cost the company incurs for raising additional capital. Now, as the amount of capital raised increases, which is on the x-axis of the graph, there are two counter effects that occur. First of all, the returns from investment decrease, which is the downward sloping green line, and the marginal cost of raising that capital increases, which is the upward sloping red line. Now, the intuition for the downward sloping green line is as the firm takes on more and more projects, the ability to execute each one to its fullest potential decreases given the limited resources of the company. As the firm tries to raise more and more capital, financial risk increases, which raises the cost of new debt. And if that new capital is raised through issuing new equity, it raises the cost of capital as well because of flotation costs. Now, the x-coordinate of the point at which these two lines intersect, the green and the red lines, is the optimal capital budget. So the optimal capital budget is that amount of capital raised and invested at which the marginal cost of capital is equal to the marginal return from investing. In other words, the optimal capital budget occurs when the marginal cost of capital intersects with the investment opportunity schedule, which is the downward sloping green line. I'd like to focus in on the red line to cover what are known as breakpoints. The red line is not a smooth curve. In fact, it increases in increments at certain points known as breakpoints. The amount of capital represented on the x-axis at which the weighted average cost of capital on the y-axis changes due to change in cost of one of the sources of capital, either debt or equity, is referred to as a breakpoint. So in summary, as we look at the investment opportunity schedule, it should be clear that the firm should undertake all those projects with IRRs greater than the weighted average cost of capital in order to maximize the value created at the firm level. At the same time, no projects with IRRs less than the weighted average cost of capital should be undertaken because that erodes value created by the firm. Let's switch now to explaining the role of the weighted average cost of capital in determining the net present value of a project. As we just stated, project returns that are higher than the weighted average cost of capital are value creating, and those that are lower than the weighted average cost of capital are value destroying. Now, if we use the weighted average cost of capital as the discount rate for the NPV calculation, there are two assumptions that we're making. Firstly, we're assuming that the project risk equals the company average project risk. And secondly, we're assuming that the project will have a constant target capital structure throughout its useful life. What we need to understand is how appropriate is it to use the weighted average cost of capital as the discount rate for our NPV calculation. Now the answer there is it depends. We need to compare if the specific project risk is less than the risk of the average company-wide project, then we need to use an NPV rate which is lower than the weighted average cost of capital. If the project risk is equal to the average risk of the project in the company, then we can use the weighted average cost of capital as the discount rate for our NPV calculation. And finally, if the project is riskier than the average company project, then we need to use a rate for NPV calculations which is higher than the weighted average cost of capital. This is because the components that make up the weighted average cost of capital are based on the existing level of risk across the firm. Do subscribe to the channel if you find the content useful. Thank you and see you next time.